Okay, in this Synoptic economics video, we're going to take a few minutes looking at some of the micro and macroeconomic factors that influence business profits. The background for this is quite interesting. Some businesses have been accused in recent times of using the current cost of living crisis as an opportunity to generate extra supernormal profits. And this has come to be known as greedflation or profit push inflation. Businesses that haven't been able to raise price for some time because of low inflation deciding this is an opportune moment to increase their prices by more than their costs. However, the data on the right hand side here shows perhaps a trend decline in the net rate of return on capital employed, which is a kind of measure of profitability, if you like, for non-financial companies in the UK. It's fallen from about 11% in 2016 down to just under 10%. So there has been, if you like, a fall in overall profitability in the economy. So what about microeconomic factors that might affect profitability of businesses? And you might be given an opportunity to choose an industry of your choice. You may know something about construction, for example, or telecoms, or the utilities. Well, on the micro side, I think the key one would be a change in costs. So it could be the case, for example, that a business experiences a rise perhaps in variable and fixed costs. Variable costs, of course, depend on output, and they might rise when the prices of the components a firm buys, energy, cost of raw materials, cost of short-term labour goes up. Now, depending on the coefficient of price elasticity of demand, the business might have to absorb rising costs in lower profit margins. So it could be the case, for example, that the construction sector faces an increase in wage costs, building materials, the energy prices they face, the cost of cement and bricks and sand goes up, and glass. So their variable costs have gone up, and that may affect their profits. I'll show you a diagram on that in a second. Another really key micro factor would be perhaps at an industry level the strength of competition or contestability. So, for example, the entry of new businesses into a market might cause a fall in prices and a drop in supernormal profits. And a good applied example there might be the impact of the rapid growth of Lidl and Aldi on the profits of established UK food retailers. They're still profitable, but Lidl and Aldi, the deep discounters, certainly have put extra competitive pressure on those kind of businesses such as Tesco, Sainsbury and Asda. Now, again, I'm not going to draw too many diagrams here, but here's a diagram showing an output of Q1 and price of P1 for making quite a good supernormal profit there. If variable costs go up, MC and AC shift to MC2, AC2, and a profit maximising firm will produce a lower output, Q2. They might be able to increase the price to P2, but as you can see, demand is fairly price elastic, so they're only able to increase that price a little bit, whereas unit cost has gone up from C1 to C2, and as a result the profit that's made in the green area there is much less than it was before. Now in the exam, label rather than shade areas, but there's a good example of how rising costs can affect business profits at a microeconomic level. Now what about macroeconomic factors? So give me some macro factors that might affect profitability of businesses. You might want to pause the video here, take a moment to write down your own thoughts on this particular question. Well, one is the exchange rate. I think any question on businesses and profits and costs, I would definitely bring the exchange rate in. Not every business exports, but most businesses, for most businesses, the exchange rate is important because of the things we import. A depreciation in the external value of the currency, for example, the pound falling against the euro or the dollar, ceteris paribus, other things being equal, will lead to an increase in the profitability of exporting goods and services overseas. Hopefully they'll sell more, so an increase in the volume or quantity of exports of cars, for example. If the pound is weaker, causes an outward shift of demand. So you go back to our diagram before, the average revenue curve would shift out and increase profits. However, many exports require imports. If you're making cars, the cost of your steel, the cost of your software, the cost of your glass, the cost of your engines might have gone up. And of course, if the pound falls, if the pound depreciates, imports become more expensive, offsetting the exchange rate effect. And another key macro factor must be the growth of demand, where you are in the economic cycle. So let's take a fall in consumption in this case. The government's been increasing taxes. They've frozen income tax allowances. They've increased they've increased corporation tax. A lot more people are paying income tax. Tax burden overall has gone up as a share of GDP. Now, if taxes rise, consumption will fall because there's a fall in disposable incomes, and that will affect demand, won't it? Businesses in some industries, particularly those with a high income elasticity, maybe luxury travel, tourism, dining, restaurants, and so on and so forth, will see potentially quite a big fall in demand for their products compared with staple industries. People who buy pretty much the same amount, whatever it is, detergents or washing powders, or processed foods, for example, with a lower income elasticity of demand. So I chose the exchange rate and the growth of aggregate demand as my two key macro factors. The most important thing is that you're able to think of micro and macroeconomic influences, factors affecting something like business profits. Apply it where you can, develop a diagram, and then obviously once you've built the analysis, get stuck into evaluation. Thanks for joining in. Take care. Stay safe. Stay happy. Stay curious. And see you sometime soon.